Good evening, everybody. Welcome back to my channel. Yes, it is me, the Wingman. I am here to deliver some delicious and wonderful content. Yes, let's get it. I am here to help you guys on your investing journey, whether you are investing in dividend growth stocks, whether you are doing e-commerce, doing drop shipping, starting a business, buying a house. I'm here to help assist you in your everyday life to make money, not only for yourself, but for your family. And on this channel, we talk about everything from investing, lifestyle. I travel a lot, so I just came back from Colombia and Vegas at the beginning of this year. I'll be at Miami for my birthday in November. Beard growing in, and then also most importantly, next year, 2024, I'm thinking Brazil and I'm thinking Thailand. Yes, I've been to Thailand a couple years ago, and I can't wait to go back. Instead of Bangkok, I'm thinking Phuket. No, I'm thinking about Pattaya. So I'm thinking about Pattaya for about a week in the Philippines, and then to do a week in or a week and a half in Rio. And so, besides traveling and traveling and spending money, let's talk about making money. Okay, so as a beginning investor or just as an investor overall, uh, these a lot of times when you have a job and you invest into your 401k, you already down the path of investing, so you probably know a little bit about some, or you probably really don't know nothing at all. And so, if you invest into your 401k, you've already started along the path of the journey to invest, and so that's good. That's great, right? Good, good, good. Now that's time to graduate. Now it's time to graduate. It's time to and this we're not going to be stock trading or on options. This is just strictly investing, right? Investing, and when you invest, you have a time horizon of 10, 15, 20 plus years down the line, not 5 years. So long term investing. And so let's talk about the common mistakes that new investors or investors tend to make when they are investing. And guess what? I've been investing for 8 years, and I even go back and forth with this or these tricks and mistakes. It's just all a part of an investor, right? So one mistake is to put all your eggs in one basket, and with that, tend to according to William Buffett, basically, if you want to receive high returns, uh, tend to people tend to hold less stocks. Now, when you hold less stocks, just know that it's very risky compared to if you were to invest in like VTI, VU, just one ETF, but that one or two ETFs comprise over 500 stocks or the whole entire stock market, compared to the risk of just investing into Apple or Microsoft, Chevron or Procter and Gamble, Walmart, etc. When you only invest into one stock, common sense wise, it's extremely risky. Just like if you want to go even to more risky, invest into Bitcoin or Ethereum. By just investing just into Bitcoin, guess what? I invested to Bitcoin 2 weeks ago. I bought at 29,000 because I was thinking that Bitcoin was gonna range up, right? Due to China and China defaulting on their debt and whatnot. Guess what? Markets were in the red, markets down, and then guess what? Crypto is down, and a lot of the altcoins are going down, and Bitcoin is going down now. And Bitcoin now is at 26,000. I'm at a loss. Guess what? This is the best time to buy more. But putting all the eggs in one basket, a lot of people want to get ri- a lot of people want to get rich quickly. So like I'm gonna dump all my money into Tesla. I'm gonna dump all my money into XY stock, right? And a lot of times, a lot of people like Chicken George and all these other people, they tend to, you hit it big when you more high risk, high reward. But other people, you choose the wrong stock and you go all in your egg basket. Guess what? Many times or not, a lot of people get burnt. So for number two, trying to time the market. A lot of times what people see is that when when you're finally in a bull run, and when you're in a bull run, you know when like every week or every other week the market is just going up, and you just don't like on certain days, green day, green day, green day, and you just wonder like, man, when the market is gonna go in red because you want to hop in the market, right? You have you have 1,000, 5,000, 500, 250, $300 that you want to put in here or there, right, on a stock, but particular stock, it's probably ran up. Like let's give you an example, like Visa, right? You want to buy Visa at 205, but you see that every other day that it's a green day, the stock market is increasing, which means that you see that Visa has just ran up from 205 to 235. So then now you're stuck with a choice of, do you want to pivot? Do you want to invest in something else? Or do you just want to wait till it fall? That's time in the market compared to dollar cost averaging, taking a day per month, and you're buying that ETF or that stock every month or every 2 weeks, every 3 weeks or whatnot. Rather the stock prices is up here, rather the stock prices down here. Your dollar cost averaging, and along the way, you probably bought some of the stocks down here, some of the stocks up here, some of the stocks in the middle, and they're just all average all together. And guess what? A lot of times, dollar cost averaging is way better than trying to time the market because we're human. You can't really predict to see what's going to happen, right? Or you don't know. Number three, buying last year winners. And so what happens is that, for example, this year, 2023, NVIDIA is up, I want to say like 153 or 250%. And so what people tend to do is that they go off the winners of last year. And I've been uh, at fault of doing this as well, where you fall in love with uh, a particular stock or a particular sector based upon how well it has done like a year prior. And so you go all into tech, you go all into industrials, uh, finance, et cetera, right? And then guess what? You think you're like, oh, it's 2022 or 2021, this stock or this ETF produced returns of 30%. Okay, it's going to do that again this year. And that's a lot of times us human beings. We're buying the last year winners. We're assuming, and that's a lot of times we get burnt. Lastly, uh, thinking short term. So a lot of people, when they are investing or when they want to invest, they think short term. And yes, we got to pay our bills. Yes, we got to eat. Yes, we got to look out for our families. For me, on the other hand, I'm single. I don't have any children. I understand some people out there, they do have children. They do have responsibilities. It's understandable. But this is where creating a budget, writing it down, making your finances automative, et cetera, how the money coming out even without you knowing or paying attention. Uh, Automate your finances, and a lot of times when you move away from thinking short term to more long term, it helps out. But a lot of times, a lot of people are like, man, do I really want to put this $250 into Microsoft or Apple, or I can use this $250 and buy some boots and buy some uh, heels, right? You know what I'm saying? Now I'm not buying heels because I'm a guy, but just thinking in the mind of a person where when it instead of thinking long term and you put your money that, okay, I'm investing now, I'm going to continue to invest per month so I can get a nice sweet retirement pot of 500,000, 750,000, instead of sticking to the plan and the budget as I see fit to let you know that, hey, I'll suggest you invest $500 into VU, $500 into VTI per month, right? A person that's thinking short term would be like, that's too risky. That's, what if I lose my money? I'd rather use that $500 and you know go travel to Costa Rica, or go just blow the money. And years later, when a person gets older, then they wonder why, they only have to live on Social Security, or their Social Security is probably like run dry or whatnot. And the person didn't really take it serious to think long term and down the line, instead of just thinking short term of, oh, if I do this, do that, this person will laugh at me or judge me or uh, whatever. So it's your life. You decide what you want to do. You make decisions for your life. You stand on it. But most importantly, make sure you think long term and not short term. Because when you think short term, you will use your money that you saved up for investing, uh, and blow it on tables, bottles, and liquor, and you'll find out that you could have really had a big portfolio that pays you thirty to $50,000 passively, but instead of that, you didn't have any. You didn't feel like you wanted to sacrifice it to make more money. So, for me, I would say outside of that, another common investing mistake is not creating a Roth IRA till it's too late. So the earlier you are, make sure you open up a Roth IRA. Make sure you fund the Roth IRA, and then make sure that it's way before 59 and a half, so that you don't get jammed up if you decide to invest money into your Roth IRA. Let it grow tax free. Then guess what? Boom, you got way more time for your money to grow and compound. But a lot of time tend to ignore the Roth IRA, or when you do, tend to open it a little bit too late. And the Roth IRA is such a powerful tool. Like right now, I got $10,000 in it, right? But I'll hopefully if it to grow to 800,000 and 900,000, so that when I sell it or when I convert some assets into uh, realty or realty income, that the money that's coming out of that particular account will be tax free. So, who wouldn't want $500 to $1,500 of just tax free money? I would, and so this is why uh, I go about and do that. And lastly, another just common investment mistake is just basically uh, time in the market beats time in the market, and that I spoke about that before. But a lot of times, a lot of people they like to try to time the market, time when to get in, and when you try to time it, that's when you lose. So make sure you guys dollar cost average. Make sure you guys, if you love dividend growth investing, to retaining and maintaining those sweet passive income dividends. If you have any questions, like and subscribe to my channel. Hopefully you enjoyed my video. The common mistakes that investors tend to make: absorb it, write it down, make sure you don't make it, and make sure that you stay on the path to at least make six figures or a six-figure portfolio. All right, you guys have a great day.